Hello and welcome to this stock analysis update for Shell. Before I start this video, please remember that I do these just for fun as a hobby and always speak to a qualified financial advisor before making any investment decisions. Shell are the UK's largest FTSE listed company. According to companiesmarketcap.com, Shell are the fourth largest oil company by market cap, and recently they've been achieving amazing free cash flow with 46 billion of free cash flow in 2022. Now that was, however, with these elevated oil and gas prices, and this year, as I'll get into, has been a bit more of a normal year, but still achieving, as per the interims, 22 billion of free cash flow. They're only paying mediocre 3.9% dividends, but they are returning a lot to shareholders via share buybacks with 4 billion per quarter in 2022, and just recently that's been shifted down to still an impressive 3 billion a quarter. We can see that their revenues are fairly evenly distributed in 2023 interims, which is a kind of back to the new normal kind of year, with 22% in integrated gas, 30% upstream, 14% marketing, and 15% chemicals and products, with 90% renewables. Now, in 2021, they announced this Power in Progress strategy. And although they're still saying that they're on the rails of the Power in Progress strategy, they had this Capital Markets Day in 2023, where, as far as I can see, this has been kind of butchered. And they've made some quite fundamental changes now to their strategy. So they're going on the premise of lots of free cash flow. We can see they had in 2021 40 billion and then 46 billion in 2022. That's because they used a lot of that extra cash from the oil bonanza to buy stuff, and then 20 for certain investments, and then 22 billion in as per the interims of 2023. And they're saying that they're expecting to maintain these kinds of high free cash flow numbers, which does make sense, mainly because if you look at the oil price, you can see here 2021 was a kind of new normal year when you compare with history, and then 2023 we're back to the upper range of the new normal. So, all bar a worldwide recession, it's quite reasonable to assume that they are going to be able to keep on generating this much cash in the short term, in the short to medium term. Because 22 to 25 billion of that is going to be maintaining their current oil assets plus boosting LNG. And that's changed because before they were dropping their oil assets. They've changed from dropping it to maintaining it. And then 14% is going to be in renewables, which is roughly the same as before. However, there's been a bit of a change in tack in that whereas before they were looking at using up to 5 billion of excess cash in speeding up the renewables stuff, now they've changed it to, well, we will be doing this investment in renewables, and they've said 10 to 15 billion. I think off the top of my head that was over the next 3 years, but can't quite remember. But they are going to be investing in renewables, about 40% of this, but only on a case by case basis where it's profitable to do so. And so that is definitely a change in tone. And then, of course, reducing debt remains as a secondary objective. So going through their reporting segments, upstream is oil and gas production and transport. And actually, 85% of the revenues from this are inter-segment sales. So I interpret that as them selling crude oil to their own oil refineries and chemicals and products to then refine that oil. Then in chemicals and products, that's petrochemicals, refining, trading, And to my surprise, only 2% of the sales there are inter-segment, which would be selling the refined gasoline to their petrol stations, which are in marketing to then sell to customers. Now, when I look at the segmental breakdown in their annual report of 2022, it doesn't make sense to me why such a small proportion of their chemicals and products revenue, which is what's coming out of their oil refineries, is inter-segment. Because when I've looked into how much oil is going in and out of their refineries, and then match that with how much oil they're producing, I get that actually the majority of their oil that they produce is the same as the amount of oil going into their refineries and then being passed on to customers. So I don't understand why the intersegment sales are so low for chemicals and products. And if anyone knows the answer to that, please do put into the comments. There's always a first time. Anyway, there's something I don't understand there, but still, their marketing is their petrol stations, EV charging, lubricants, and biofuels. And then the integrated gas, that's mostly liquefied natural gas. And then, of course, there's renewables, which is mostly solar panels. So when we look at the profits by business section, we see a fairly good distribution. And so what we see now is the return of Shell to its kind of new normal kind of operations, with Brent oil above $70. And you see British national gas prices, they've normalized back to more historical, but they're actually still a tick above the long-term averages. So this is the kind of new normal prices. And so you see that with these current hydrocarbon prices, they get a nice equal distribution from each of these reporting segments, as they always used to. What's interesting is if you get a massive increase in hydrocarbon prices, you see the integrated gas and the upstream, they get a nice massive bonanza in these business segments. But then otherwise, they're still just generally doing okay across the segments. And so this distribution we're seeing here now is more of the kind of normal distribution from across their business segments. There's a couple of little nuances to point out here. First is renewables. Actually, this result here is quite misleading because, as you can see, you get massive negative values and then positive values from quarter to quarter. And when I dug into that, that's actually because when you buy a load of windmills or something, investing a load of windmills or solar panels, what happens is you kind of agree with the government what you're going to get for the electricity. They only very marginally make business sense, these renewable projects. So you have to rely on these contract for differences auctions with the government, where the government basically promises to pay you this much in the future, and then that gets hedged against these contract for difference derivatives. So what happens is as the price of electricity goes up or down, and also other things like, did the wind blow that year and other stuff, you get huge movements, which are actually movements in commodity derivatives. So what happens is overall, because it's all linked to these commodity derivatives, these massive negatives that you get balanced by massive positives according to however the price of electricity moves. And then overall, they do make, they say they're going for a 9% return on these renewable businesses, but you do make a tiny skim. But then after that, you've got to cancel out. But that's only after cancelling out all these huge moves. So in any particular year, you'll get a huge profit or loss. But then overall, over 10 years, say, it's just like a tiny skim. So that makes the renewables segment a bit kind of meaningless in terms of what the value is in any particular year. So bear that in mind when you see this 90%. I suppose overall there is like a nice little amount they get every year from that. So another thing is the amount they get from the chemicals and products. That's highly influenced by variable cost margin, which is how much does it cost to refine some oil into the oil products that we all rely on so much for our everyday lives. And as you can see, although VCM has dropped quite a bit since 2022, compared with the other things, is actually way higher than it was in 2021 and before. So you can see that they're making quite a lot of money from the oil refining compared with historically. So overall, when we look across these four categories, Shell are systematically doing better from their chemicals and products segment, and also the integrated gas and upstream are doing a little bit better than historically. You know, it's the new normal of perhaps slightly higher gas and oil prices. So just as the baseline, they're actually outperforming what they were historically. Here I've got the Shell share price versus oil price in orange. Actually, in lots of times in history, the Shell share price hasn't tracked the oil price that well, but then actually in the last 5 years it kind of has. Now, in some of the earlier videos that I did on Shell, you can see I go into a lot more detail on some of these news items, particularly where Shell were under attack from the activist shareholders and from Greenpeace. So go and look at those earlier videos if you're more interested in that. But just to briefly go through the timeline here, since about 2008, Shell had been selling off quite a bit of a significant chunk of their hydrocarbon assets, but they had been investing a bit into LNG, particularly in Canada. In fact, they did a 30 billion divestment program. Then, as we came into 2020, this was obviously the time when the share price went down a lot for all oil companies. And this was a combination of, we had the corona crisis, but what also was happening that people perhaps weren't highlighting so much was we had the shale boom, which was bringing down the cost of oil and gas. But then also there was the OPEC price war, where the OPEC countries were deliberately overproducing to deliberately bring the price of oil down to try and put the shale boom companies out of business. From 2020 through to 2022, there was all this, the Shell board were just continuously under attack. Lots of court cases with people like Greenpeace, and Greenpeace actually won a court case against Shell in a Dutch court in 2021, where they were essentially being punished for being an oil company. And then, interestingly, Shell moved the company from Holland over to the UK. Now, ironically, before they got done in court, they'd just done their Power in Progress document, and a lot of that was supposed to placate these activist shareholders and environmentalists. And then, of course, in 2022, we had the windfall tax. So it's very interesting that Shell did actually do quite a lot to try and say, you know, we're going to invest lots of money into renewables and we're going to go net zero. But it was like everyone hated them anyway. And so that's why I find this change of tone very interesting, because I feel like I feel like mainly a lot of the troublemaking shareholders, maybe their voice is just drowned out now. And, you know, a lot of the ones that were threatening to leave and may have left have left. And now we've got a bit more of a more sensible strategy, I think, moving forward with 30 to 40%. I didn't highlight this enough actually, but rather than just a 20 to 30% return to shareholders, it's now increased to a 30 to 40% return to shareholders. Tumultuous times for Shell, and I go into that in more detail in my other videos, but coming out at the end of that, they seem to have a much more balanced strategy now, which should be good for shareholders. So I'm now going to go over my data updates for each of these business segments. You can go back to my earlier videos as well when I go into more detail on actually how each of those business segments tick. But integrated gas, and we can see here how the hydrocarbon production has continued to fall as of full year 2022. But we understand that that's going to start to stabilize. LNG is looking robust. The only real big moves in 2023 was that they sold a stake in their Indonesian Masila project. These are their LNG liquefaction plants. And something I picked up on was that at the Capital Markets Day was apparently in Nigeria they're having lots of problems with thefts from the pipelines. And that's actually their largest facility. So something to know about. I'm not losing sleep over that, but that's certainly something to highlight. And this is where their regasification takes place. So I've got a nice graphic here where you can see where they liquefy the natural gas from places in the world where it tends to be cheaper. And this is where they gasify it to sell to people. And you see that unfortunately, a lot of that is in the US. So a lot of their LNG, a lot of where they sell LNG is in the US. This is why I think Total Energies are better than Shell because Total Energies LNG is liquefied mostly in the US where the gas prices are cheaper, and then they gasify it in mostly in Europe where the prices are the most expensive. Shell, most of their customers are in the US, so not so good. But they are actually now they're saying the number one LNG supplier in the world. So overall, they do have some Europe, and they're only half the US, and there is arbitrage between these places and the US. So overall, they're still doing okay. But I do love to point out how Total Energies have the best LNG strategy. So Upstream, and you can see how actually their reserves have gone up, even though they're pretty much only maintaining. And so I think with their actual strategy and they've actually been quite saying this actually at Capital Markets Day, that they're not really going into new territories. They're just doing add-ons and extensions and things to their existing territories. But actually, with this more minimal investment, they are able to keep their hydrocarbon reserve steady at minimal cost just by tinkering with their current territories. So that's interesting, and I generally think that there should be a good at least 5 years before they'll be in a position where they really have to start doing some proper exploration again. Actually, it's my kind of gut feel. And then their hydrocarbon production is, as you can see, has been dropping, but we expect that to stabilize. They're actually a bit more gas than oil, which I think is good, because I think gas is where most of the money is to be made in the long term. In terms of upstream investments, there is investment in a North Sea Piercefield rig, but to be honest, that's nothing that big. And they sold their onshore ventures in the US. This is a breakdown of where they produce their oil and gas. If you want to print screen, and here you can see the yellow barrels are where they are producing their oil. A lot in Saudi Arabia, A lot in Brazil, which is a good area, and a lot of presence in the US. Generally, most of Shell's operations, be it oil production or anything, they tend to be in the safer places. So they bid more, they're prepared to bid for more to get the assets that are in squeaky clean, safe location where there's not going to be any military coups or anything. So the chemicals and products segment, and we can look at how the amount of oil refining has been continues to drop, as does actually the oil product sales. And of course, in the countries where Shell like to operate, it tends to be more expensive to refine crude. You're better off, it's places like India and China where it's cheap to do that. And so this explains why they shadow of themselves what they used to be in this department. And as far as I can tell, they only have they have refining only enough to cover the crude they produce. They're doing refining just as much as they have to for it to work for their business model. They actually sold off a refinery in Texas in the US in 2022, but in November of 2022, they actually opened a new chemical project which was called Shell Polymers Monaca. So here we see in terms of their chemicals, actually their thousands of tons per year of ethylene capacity is now increased thanks to that. You can see here the breakdown of where most of their petrochemical plants are, and I think that they are. Here's their actual chemical plant breakdown. So here's their new one, but I believe that they'll be closing down a lot of these others, and they want newer ones that meet the new regulations and everything, and probably a bit of a focus on recyclable plastics and stuff as well. Here's their oil refinery intake and outrun. This is here where I calculated how much refining they're doing. This is where I calculated what their refinery capacity is. You can see actually the bulk of it is in Europe. You know, maybe this isn't a perfect mix to me, particularly because they're mainly focused in Germany and Netherlands, which have got to be kind of more expensive places, I'd have thought, to run an oil refinery. Here's their marketing and sales volumes, which you can print screen if you're interested. So on to marketing. There's one big bit of news in 2023, which is they bought Nature Energy Biogas, and you can see if you look at this breakdown here of their marketing sales, you'll see that a, actually perhaps a quarter of it is in this sectors and decarbonisation segment. So that I think includes this biofuel project. So they're slowly kind of expecting a retreat gradually over many years from mobility, which is your traditional gas stations, presumably because they think less people will be driving in the future. And then, but they want to then gradually supplement that with this by shoving the biofuel by shoving biofuel into the marketing segment, which is, to me, I don't understand why it doesn't go into the renewable segment actually, but still, that's what they seem to be doing here. So renewables, and they've actually boosted their installed capacity, but it's currently only 2 gigawatts with 4 gigawatts in development. And it's interesting that actually Shell and BP, and in particularly in case of BP, because they more than anyone were being heralded as switching into renewables, but actually, really, after all the shouting's over, Shell and BP are both very small here at just 2 gigawatts when you compare them to Total Energy's 16 gigawatts. ties in to all the drama that was going on. Whereas in 2021 and 2022, there were lots of news stories. There's actually no big news stories that I think are worth mentioning in 2023. So we can see how Shell have changed tack a bit, which I think is a good thing. And renewables is left as this reporting segment where it's still only really a minor focus of the business overall, as far as I think, anyway, in my opinion. So now to take a look at their numbers, and I think it's good to get some context from the oil price. And as I've said before, we're at this kind of new normal kind of price at the moment, and actually 2021 is a good comparator of the kind of new normal oil prices that's good to compare with to assess how Shell are doing, because 2022 was obviously a bonanza year, but not really good for comparative purposes of what normal is. And so when we compare with 2021, we see that with the interims, actually Shell are doing well compared with the other new normal of 2021, with their interim revenues of 165 billion, costs of 153 billion, and operating profit of 20 billion and net income of 12 billion. So we compare that 2021 full year, they look really on track to do everything they've said they're going to do in their Powering Progress strategy as amended on the Capital Markets Day. Now, in my earlier videos, I go actually into lots of detail onto what each of these line items are. So go and look at my earlier videos if you're interested in that. But to try and speed it up a bit, in terms of revenues, we see that the base revenues seem to have dropped. When you think of oil prices as well, from what it used to be in the olden days with now, and that's because they dropped maybe from say 350 to less than 300 billion, but that's obviously because they did do lots of divestments. But it's interesting that from that slightly smaller business, they're able to generate better profit. So they've actually did go through a bit of a restructure that's kind of looking better. Plus, we've got to realise that we're now living with slightly higher oil prices, slightly higher gas prices, and also better variable cost margin, which improves things in their chemicals and products segment. Their numbers here are really good. They are outperforming really where they were, more recent times before the silliness started. And they look in rude health here, with looking like they'll achieve roughly 25 billion of net income and perhaps 40 billion of operating profit just going on their interims. We can see their revenue here is much higher than their main expenditures, which are purchases, production and manufacturing expense, and selling and administration expenses. All these other things are fairly, are kind of completely out of proportion with these numbers. When you look at the revenue and then take away their main costs, they do have their profit and loss statement looks extremely healthy. And here you see where I put that into a graph, and we see a very nice widening between the income and expenditure. And looking at these dots here are the interim numbers for 2023. You see that at this new normal of oil and gas prices, they're looking very healthy in terms of their difference between their income and expenditure. It's interesting that their exploration here is only about 2 billion a year, and that's a tiny fraction. It's almost like a drop in the ocean. the large difference between their revenues and their costs. So that's very promising because they've got this runway of a good 5 years where they can just extend current projects a bit without even doing that much exploration and still maintain their oil assets. And then so you can see that there is scope for when in the future they need to do more exploration. That's something they can do. In terms of their assets and liabilities, again, look at my earlier videos when I go into the line items in more detail, but it's actually dominated, the assets are dominated by property, plant and equipment. And I've got a breakdown of that here. And it's actually, most of the assets are really quality assets. It's 45 billion of cash. So, okay, just a few things first to point out is, as you'd expect from this amazingly positive profit and loss statement, the cash is building up here really nicely. And now they're up to 45 billion in cash. However, they do still have 70 billion of debt, but they have been paying that down a lot with this cash flow. But still, you do have that niggle with Shell. They still do choose to hold debt, and they seem to rather do share buybacks than pay off debt, whereas I'd be doing it the other way around if it was me. A quarter of those assets are current assets, particularly cash, trade receivables. They've got 52 billion of oil that they've sold, and they're just waiting for the money, and 27 billion of inventories, which is literally barrels of oil that they've produced but they're ready to sell. So this is extremely healthy assets of 140 billion, and that's over a quarter of their total assets are just liquid gold essentially. And then that you've got reflected here. And then when we come to their long-term assets, that is completely dominated by property, plant and equipment. So that's all their oil rigs and everything, and all their production assets and supply assets they've got all over the world. So again, those are fairly robust assets. So overall, it's a very healthy asset set they've got here. Of course, the debt, the liabilities they have, it's unfortunate that they've got 72 billion of debt. They have actually about a quarter of their liabilities are short-term things just for normal running the business, way outweighed actually by the short-term assets, which is always a sign of health. But then going on to the longer term, really the bulk of that is their debt, which is, it would be so good if they could shrink that down. If someone can explain to me in the comments why oil companies tend to like having lots of debt, why that works for them, please put down in the comments. I'd appreciate that. But back to my graphic here, I've lined up their liabilities here against their assets. And then you've got the difference here. Then here is their market cap, which is a price to book of 1.2. So from this graphic here, they look fairly priced. Now, one thing in my earlier videos, actually, I asked in my earlier videos, can someone explain where the oil is? Because I can understand, I can I thought that the actual oil in the ground that a oil company has rights to would be in their long-term assets, but that isn't the case. And I'd like to say thanks to the people on the Portfolio Matters Discord who helped me out with this. But for oil and gas companies, the actual natural resources that they own the rights to, that are proved resources, those aren't actually considered on their balance sheet as a long-term asset. Those are actually separately considered supplements where they get experts to state this is what we think our oil and gas reserves are worth. And so when you value an oil company, you've got to consider that on top of the from just looking at the price to book. And so I've gone through all of Shell's annual reports, and here you've got the price of oil at the time and what the discounted future cash flows valuation was for each of those annual reports. Because in this case for Shell, they've done it for using the price of oil over the previous year. So you see it changes quite a lot each year. For the price of oil bad year, which was 2020, a good year, which was 2022, and an average year, which was 2021. I've got some very nice rough valuations here of what Shell's oil reserves are worth. And this is actually, I should say, I've only used the Shell subsidiaries number to be conservative. The joint venture numbers weren't that much anyway. So just to be conservative, I've just used their subsidiaries number. And you've got to remember that this is only their proved reserves. So you've still got lots of other reserves which have not proved, and also probable, and undeveloped reserves and things as well. But just to be uber conservative, we then get a value of 28 billion at $40 oil, 70 billion at $71 oil, and 112 billion at $101 oil. This allows me to visualize the value of Shell's oil in the ground after you've taken into account the cost of extracting and everything. This is the value of the future profits they can expect from the oil in all their oil reserves. And then I've got that against my valuation graphic, which I do. And first of all, just to focus on that, Shell have been buying back a lot of shares in recent years. You can see here the total numbers of share in issue has dropped from 8.3 billion in 2017 to only 6.9 billion now. And so I think that has helped keep their market cap muted. And we see how, even though we're at this kind of new normal, the market cap does seem fairly reasonable against what it was historically. If we look at 2012 to 2019, the oil price was lower than it is now, and also the gas price much lower. So bearing that in mind, the current market cap of Shell, they still look nicely valued. Never mind the price to book of 1.2 when I compare them against the net assets here. Also, look at how nice the net income looks. The cherry on the cake would be to see this debt reduce. Still, so I've got the market cap is only a tiny fraction above their net assets. So even a really bad case of $40 oil, they still look fairly nicely valued. And if I take a look at the $70 oil, this company is looking very, frankly, cheaply valued. So it's great to. This was actually the kind of final piece of the puzzle, I think, for my valuation of some of these stocks. So thanks to the guys on Portfolio Matters who helped me through that. But this is something different actually to my last update I did on Shell. And with this, I'm fairly happy with how Shell are currently valued. Now, it also tells you something about how to look at value companies, perhaps compared with growth companies. So here I've got a dot plot, fairly out of date, but it just shows you how the commodity stocks are generally valued by the markets with lower price to earnings, price to books, as IT and other funky stocks. And I think that's because of this, the expected future cash flows. So for value stocks like Shell, it's actually not that much higher. Even the best case here of $100 oil, you don't really expect the stock to even double on that. And however, in the long run, the risk is lower. It's fairly kind of almost guaranteed return. I mean, you look at the worst case and high case. Yeah. So what I'm saying is, there's not that much difference between the worst case and the high case against the overall market cap, but it is generally safe money. And so herein explains the kind of valuation generally of these value stocks. Whereas with the IT stocks, they currently tend to be horrifically overvalued when you go just by this graphic, but then you're expecting huge future revenues to then compensate for that. I think a real good learning point for me, and we see that they are very, very nicely valued, I think. And for me, this was when I bought the Shell originally. I mean, actually, I initially bought BP down here, but because 40% plus of BP's resources seem to be based in Russia, I then sold and then switched to Shell here. But still, even going from here, I can hold on to Shell and enjoy these dividends as a value stock. And I've got like a stop loss, and then if that gets triggered, I've still made money if I sell. I'm looking at Shell now as a nice value stock to hold, particularly as I bought at cheaper prices. Going through the future discount cash flow data for them, that reiterates my feelings on how they're relatively cheaply priced. They're never going to 5x, but I can expect a good reliable income from them in the long term. And with the oil and gas market set up as they are, I think holding on to Shell now, all the fundamentals are in your favour, with the exception of if there is a worldwide recession or whatever. But generally, they do look like a great value stock to me. Going into the cash flows, and first of all, starting from the cash flow from operating activities, they achieved 29 billion from operating activities, 2 billion from disposals, and 2 billion net investment inflows. And then they only pay 12 billion in capex. Actually, that's capex plus, so capex and other things to keep stuff ticking along. 5 billion in dividends, 3 billion paying off debt, 2 billion of interest, and 8 billion of share buybacks. So when I take away this stuff they don't have to do, we see that generally from this 29 billion of operating activities, after the 12 billion of capex and 2 billion paying off interest on debt, they still have a large amount of free cash here, and that has allowed them the 5 billion of dividends. And then they've still got 8 billion to do share buybacks if they want, or 8 billion to do whatever they want with. But it amounts to 12 billion of extra cash every year that they can kind of do whatever they want with. So talk about a cash machine. Looking at the cash flow statements here, it totally validates how great they look when you go just on their net income. Something new that I've started to do is look at the cash flows before you get to the cash flow from operating activities. So that's this consideration. Plus, you've got to go back to the raw kind of profit and loss numbers. But I think that's well worth doing because this really does give you the purest view of how the company's ticking in terms of cash flows. And so then you start with their revenues of 162 billion. Each of these squares represents 10 billion. And you can see their revenues, are here as these, their enormous revenues. Here, by the way, I'm looking at their interim results, and I think that's appropriate because their 2023 interims are a kind of new normal standard good numbers to go on. Now you see that actually all the other incomes here only come to 3 billion, okay? So those get bundled into this other net cash flow adjustments. On the expense side, it's mostly the purchasers, with then, as I said before, the production expense and selling and admin expense, which you see down here in their expenditure. Importantly, depreciation, depletion, amortization, that gets cancelled out because it's kind of like a phantom cash flow. You put it on your profit and loss, but it doesn't actually represent real money moving anywhere. That leaves you with just all these other things which are actually so minimal. Million R&D of 0.6 billion, exploration of 0.8 billion, and so by the way, tax gets reconciled out, and you only include a bit later on the tax you've paid, not actually what goes in here, which is the tax that's due. But all these are just little bits, which then you can nicely visualize here. All these bitty stuff, it doesn't actually really matter in the overall scale of things. So we're left with a nice view of what's really going on with the cash flows, which is this huge 162 billion of revenue, and then their purchases and production expense and selling and admin. As you can see, that then that then squares up here against those revenue. So then once you include the tax, which is the tax they actually paid, so this actually is what I'm saving from here with my representation. But the tax, you only get done for the tax you get paid in terms of your cash flows. So once we neatly represent all these reconciliations of the cash flows, they've clearly got a nice margin here of extra cash flow from operating activities of about 29 million. Those cash flows from their revenues. Once we take away those negative cash flows from the positive cash flows of their revenues, and we can see it's a very clear. There's no kind of strange tax credits and things muddying the waters. This is real pretty green being generated by taking oil out of the ground and selling it. This is a nice 29 billion. Having this clarity about their cash flows from doing that, I then go into shown here with this slide, and then I've represented that graphically with each box representing only 5 billion. And here we've got their cash flow from operating activities, which is this number here at the top of this. So we've got that number, which I've expanded to 5 billion per square. And then we have the financing, then we have the investing and financing activity, which is done on that. So we know from this that this is an extremely healthy cash flow to start with. They had 4 billion of fuzz from disposals and investment incomes, but then in terms of what they've done with that, they invested 12 billion in capex, and then only 2.5 billion was paying off debt plus 2.5 interest on debt. So then that means that only roughly half of this real quality positive cash flow is needed for their basic running stuff, actually including 2.5 billion of paying off debt. So actually you could say roughly only a third of that is used for their basic running stuff. And then that allows them, the dividends coverage at the moment is great. I mean, only 4.6 billion, or only, as you can say, 1/6 of this liquid gold here is they need to pay the dividends, and then that's allowed them to pay off a third of this liquid gold in share buybacks. So you see that this they've got a lot of room to maneuver here. You know, this is a very healthy setup for Shell, even at lower barrels of oil cost than we have today. I showed that already here, but still, you know, they really do have lots of free cash flow, and you know, 8 billion that they are choosing to spend on share buybacks, but could basically be spending on anything they liked. And then this cash gain of 5 billion, you know, that's from these kind of less quality incomes. So we can kind of actually disregard that, but nevertheless, it's some real good money here, and it's great to see that being given back to shareholders. Okay, so onto the shareholder composition, and actually, not really a lot's changed. Now onto the sector chart and trading range many months ago, and the oil, gas, and coal sector has stayed within it all that time. But then we have definitely broken below it. So that for me, so actually, while on the longer run trend, we're still actually in a good place. Really, in this within this 5 year time frame, I think we've definitely broken below that, and so this is a concern to me. And you know, we've got to remember that, you know, when we look at the share price of Shell generally, there is a risk a of a big kind of worldwide recession, and that, you know, there's lots of people screaming for that. And although it doesn't seem to be happening in terms of equities anyway, if it does happen, then that could be, you know, a further manifest. You know, this could be an early warning, perhaps, of that. I've got to accept that in terms of the sector chart, it's a negative pattern at the moment. So that brings me to the end. We've seen how I really like how Shell's powering progress strategy is shaping up. It's great to see them returning up to 40% to shareholders. I love the dividends. We saw how their revenues are fairly nicely distributed across each of their reporting segments. The renewables is a bit of smoke and mirrors, really. But core to the company are these other reporting segments where we see how gas prices are generally up, historic numbers. Variable cost margin is way up, historical numbers. And so, really, as of now, Shell are in rude health in terms of their revenues, with any intermittent spikes in oil and gas price just bringing in loads of money on those particular segments. But even back to the baseline now, things they are looking in rude health. You know, oil price is looking great at the moment, as we see this kind of new normal established. The gas prices are above, you know, what they were historically. Still, we're now setting up nicely for the winter. In an improvement to the last video I did on Shell, I included the future discounted valuing models and find Shell to, at $70 an oil crude, be actually looking extremely nicely valued. And like I said, look, if you look at the upper end, okay, this isn't a stock that's going to 5x, but they look at a real nice value here where they're currently priced in terms of their market cap. With oil companies, always a certain risk of an oil disaster happening when you'd have to try and get out quick, although they seem to be rather infrequent these in the last few decades. The big risk really is there going to be a big worldwide recession that then sends down the oil? You've got to be ready for that. and that's why I've set a stop loss for Shell. I should mention I did get a red flag on my sector chart as well for oil and gas. However, I'm a proud owner of Shell, and I'm really enjoying the dividends and look at holding on to them in the long term as a value stock. So my verdict for Shell is a hold. Here's a summary of that. And that completes my video. I hope you've really enjoyed it, and I hope you found it useful. Make sure you speak to a financial advisor though before you do any investing yourself. I'll leave you there. Have a good week, have a good weekend, and speak to you at the next video. Please read the disclaimer. Remember that prices can go down as well as up.